What's going on, everyone? Travis the Stock Geek here, coming at you with another episode of Stocks to Watch this week, here in the week of October 12th, 2020. This week kicks off Q3 earnings reporting season here in North America. We have airlines and some of the big banks reporting their earnings this week, and then next week we'll have hundreds of companies reporting earnings across a variety of sectors. But before we dive into that, let's take a look at what happened to markets last week. In terms of stock markets, most global markets were up over the past week or so. You can see here all this green on the 5-day performance numbers. And here in the US, of course, we had a really strong performance in tech in particular. If we look at the NASDAQ, for instance, it continues to really carry a lot of the market, not only this year, but even continuing this impressive performance here in the month of October. Markets really just shaking off any worries about the lack of fiscal stimulus in the U.S., shaking off worries about virus or vaccines, and shaking off any uncertainty around the elections, at least currently. I still personally think there's significant risk right now in the markets over the next couple of weeks, and I would like to see further support for an economic recovery through fiscal stimulus, but we may have to wait on that. Nonetheless, we did see tech particularly strong. We saw stocks like Apple up 6% to start the week. Facebook was up 4%. So again, we're just really seeing a continuation of a lot of the same trends and a lot of the same hot stocks moving up really significantly over the last weeks and months of this year. So as we kick off Q3 earnings reporting season, we had JP Morgan report this morning. That was an interesting report. JP Morgan actually showed that they were reducing their provisions for loan losses that they had built up over the past 2 quarters. It seems as if credit losses may be coming in a little bit lighter than expected currently. And who knows if that will change if we get a double dip recession. But right now, looking pretty good. JP Morgan actually had a higher than expected earnings beat, and that was pretty good. And they overall are pretty constructive on the recovery, but they did call out they still see a lot of uncertainty in the economic end markets that they serve. So that was an interesting one to see. Airlines a little bit worse off. Delta, it did improve its cash burn throughout the last couple of months, but still burning around $20 million a day, and posted a very big loss for the quarter, and saying that it might take up to 2 years for air travel to recover to prior COVID levels. So that is an area that is still an area of concern. Of course, we have the performances today from the companies that reported were not very good, but the markets were down a little bit today, so we may not be able to read too much into this just yet, but if we continue to see companies selling off on Q3 earnings that over the next few days, that could be a signal that this earnings season may turn out to be a little bit worse for stocks than some people might be expecting. FactSet puts out great data that I always follow during earnings season that updates us weekly on how many companies are beating estimates or missing estimates, how many companies are giving guidance. In this earnings season, we have a lot fewer companies that have given guidance, so it could be a more volatile earnings season than we've seen in some earnings seasons in the past. We also should note that the valuations on the S&P 500 stocks are above their average levels currently heading into this earnings season, so that's just something to keep in mind as we get deeper into the earnings reports. Now, in terms of other highlights from last week, one thing that's worth noting is we had quite a few companies that were showing short squeezes. I've talked in the past about GameStop, which has tripled over the last couple of months. Very, very interesting situation where the short interest was higher than the total float. So very, very highly shorted stock, one of the most highly shorted I had seen in a long time. And we had called that out to some of our members in our stock investing community, and they were able to pounce on that opportunity. But I'm noticing that a lot of other people are starting to chase similar opportunities. Dillard's last week was up about 30% in one day. This is a stock that's highly shorted, doesn't have a lot of float. Not the best in business, to be honest. It's a department store chain that has not done very well over the last couple of years and has been slow to transition to online. But nonetheless, you can see its stock has the potential to squeeze, and it actually has squeezed a lot in the past. There's been a lot of different scenarios with this stock in the past few years where the stock is up 30-40% in a couple of days because of short squeezes. So people are starting to hunt out these short squeezes. Remember also Bed Bath & Beyond was one that squeezed pretty heavily over the last couple of weeks. We also saw GoPro, which I mentioned last week, squeezing. These are all highly shorted stocks, and people are starting to sniff these opportunities out. So I like to look at the highly shorted stock list. It's not the only criteria that I use to pick stocks, but it's kind of nice icing on the cake when you find a fundamentally sound company that happens to be highly shorted, because if you do start to see good news and you do start to see the stock price recover, you have this influx of buyers from short sellers who are forced to cover, and that can provide some nice buying pressure behind you. So you'll note I've called out a couple of stocks before that are actually on this list. Stocks like Nordstrom, Macerich, which I've done a long video on in the past. These are all highly shorted, and that is something that could work in our favor eventually, just as we're seeing with stocks like GameStop, GoPro, Dillard's. GameStop was a funny one too, because they actually came out with a press release in I guess it was last week, and they were talking about a partnership with Microsoft, but that partnership was actually more about buying stuff from Microsoft. If you actually read this press release from GameStop, you'll see that most of what they're calling a partnership is just agreements for GameStop to purchase products like Dynamics 365 and Microsoft 365 and use a bunch of Microsoft tablets in their stores. Microsoft will allow GameStop to sell their Xbox All Access through GameStop, which is something that could benefit GameStop. But again, when you have a highly shorted stock, any piece of good news, even if it's maybe not the strongest piece of good news, if it starts the squeeze like it did on GameStop here last week, it can be very, very powerful. So just keep that in mind. In terms of other company highlights last week, we've talked a lot this year about Spacks, special purpose acquisition companies or blank check acquisition companies. Those continue to raise capital at a high rate. We saw actually some interesting SPAC announcements from companies like, I believe it was the Forest Road Acquisition Company, which is going to be termed the Shaq SPAC. So Shaq is teaming up with some former Disney executives to raise capital to go buy a business. Shaq is actually quite a seasoned investor since he left the NBA, but he's teaming up to form the Shaq SPAC. We also saw announcements from a SPAC called Red Ball Acquisition, which is looking to acquire sports teams. And it was rumored last week that Red Ball, would actually be potentially looking to buy out the parent company of the Boston Red Sox and the Liverpool FC Football Club. So that could be an interesting, pretty big deal. And it's interesting to look at some of these SPACs. We also got some new SPACs from Social Capital and Chamath P. So if you remember, his IPOA acquired the Virgin Galactic, SPCE is what it turned into. And then they had IPOB, which is acquiring Opendoor, and that SPAC has actually been performing really well over the past few weeks. You can see here, this one has gone up about 2.5x from the original SPAC IPO price. IPOC is actually acquiring a health insurer, but now, like I said, we've got IPOD, IPOE, and IPOF trading. So these are three newly formed SPACs by Social Capital and Chamath, and they will be looking to buy or to partner with businesses that are private to take them public. And so we could see announcements from them perhaps in 6 to 12 months time frame. But those are three new SPACs that are already trading, of course, near their original IPO price of around $10-11. IPOD is trading at a little bit of a premium right now, which is interesting. So keep an eye on the Chamath SPACs. Those always get a lot of interest from investors, especially if they end up acquiring something exciting. So the SPAC space still very hot. We've got rumored IPOs as well from companies like Instacart and Roblox coming over the next 6 months. Airbnb still rumored to be IPOing around the December timeframe. And then Affirm, the big lending company that does lending for products like Peloton, they filed their S1 and will be looking to potentially go public as well in the next few months. So still a hot SPAC and IPO market. That's definitely helping support the tech sector. We also had M&A. I believe we had a couple of announcements and a couple of rumors. We had AMD. We had AMD potentially looking to merge or acquire Xilinx or Xilinx. I'm not exactly sure how you say it, but that would be about a $30 billion deal. Not exactly sure how AMD would look to finance that deal. It's possible they'd be looking to do a stock-style merger, but this is a deal that's been rumored but not confirmed, so that is a big deal if it did go through. Of course, we did get a big deal announcement from Twilio, which announced it would be acquiring Segment, which is a very interesting little business, and it's a $3 billion deal, so it's not a small deal for Twilio, but Segment is a really interesting and really nice product of used by a lot of different companies to actually integrate third-party and first-party data sources into their data warehouses. So it helps to move data from websites and apps and third parties like Facebook ads and Stripe and other places where companies have data. It helps to move that data through to their in-data warehouse where they can analyze that data and pull out patterns in customer usage and revenue trends and things like that. So this is a really nice piece of software and a really nice company that works with a lot of really innovative companies. So very, very interesting product, very interesting acquisition by Twilio. It essentially will allow them to integrate a lot of Segment's products and become really a force in both marketing communication channels that Twilio already has, but also to be able to become a player in data and analytics. So kind of an interesting deal here, but definitely one that I would say is probably a pretty good deal, even though it's a pretty high price for Twilio. So Twilio stock was up on that deal announcement. In terms of macro stuff, outside of company-specific stuff, it wasn't a very busy week last week with macro data. It was pretty light week. It's actually a pretty light week as well this week. I think we get some retail sales data on Friday, which could be a market mover for the retail sector. So that is the September retail sales data that comes out on Friday. Not expected to be very strong growth month over month, just under 1%. Perhaps we'll see a upside surprise to that number if things are recovering faster than people expect. We do get some inflation data in the US and China here on Tuesday and Wednesday as well. In terms of earnings, like I said, we get big banks and airlines mostly this week. And I always like to listen to the big banks and what they're saying about what they're seeing in consumer credit trends and corporate credit trends. And from what we saw from JP Morgan this morning, it actually looked decent. There was nothing that really spooked me as far as what they reported in terms of credit trends. If anything, the credit trends continue to get a little bit better. So that's always a good sign. Now, what stocks am I watching this week? Well, I talked about the high short interest stocks, of course. And, I called out some of the ones that we've already seen jump, like GameStop and Dillard's and Bed Bath and GoPro, but there are a lot of companies on this high short interest list. And like I said in the past, I've already called out some ones that I think are fundamentally undervalued, companies like Macerich and Nordstrom. And I will continue to believe that those have pretty explosive potential over the next 6 to 12 months if the economy keeps recovering. And with that short interest behind it, I definitely want to keep an eye on these kind of stocks to see if there's some piece of news that could really push these things up a lot in a short time frame. So I'll be watching those. I'll be watching the Spacks that I talked about. Of course, these Spacks like RBAC, surprisingly, Red Ball acquisition, even though it's rumored to be in talks to acquire the sports teams, the Boston Red Sox and Liverpool, they are still trading pretty close to the original IPO price here, around $10.35, $10.40. So not a lot of premium built into this one yet. I'll be watching the Chamas Spacks. I'm also keeping an eye on these Spacks that are drifting down, like Jaws acquisition. This is one that IPO'd a few months back, has a pretty good sponsor with Barry Sternlicht, who is the former chairman of the Starwood Group. They're going to be looking to acquire something probably in the travel or leisure sectors, entertainment sectors. Those are the areas they're looking. And a pretty big SPAC, and it's already trading kind of near its liquidation value, so there could be some pretty nice upside eventually once this thing acquires something. It may be, 6 months before they announce an acquisition. Who knows? But that's one I'll be watching. Also watching Foley Trazimine, WPF. This is another SPAC that hasn't announced a deal. It just raised a few months back, and it's one that's kind of just been, plugging along here in the low $10 range. Not a lot of premium there to be paid. But it does have a good sponsor with a very good track record of building strong businesses, including the largest title insurer in the U.S. and some interesting software businesses. So we'll see how this one plays out. They, I think, should be pretty disciplined about the target that they're picking, but likely to be in the fintech world. So that will be a really good one to keep an eye on as well. Now, I'm also starting to think about what stocks might benefit if the Democrats don't sweep the U.S. elections. Right now the betting odds are saying that, they're putting a 2-to-1 on, or I'm sorry, like a 65% 66% probability of a Biden win, which is like, 2 times more than the probability that Trump has right now. We can also look at things like the 538 tracker, where it's saying the Democrats are slightly favored to win the Senate. So assuming they retain the House as well, that would be a Democratic sweep. So right now, the probabilities are favoring Democrats, but it's interesting to think about asymmetry and the types of gains that could be had if, the Democrats surprisingly don't end up sweeping the U.S. elections, what stocks might benefit. And some of the areas I'm thinking about would be areas like energy or refining. Those are areas where pretty beat up stocks in these sectors. And we've got a lot of interesting companies that, could provide pretty good returns if things start to turn around in the energy markets and you don't have any pressure from the legislative side. We've got fights over pipelines and things like that. So when I look at, you could even look at ETFs like the AMLP ETF, which holds a bunch of pipeline companies. And that is one that if you look on a longer term time frame, you can see is down a lot over the last few years. Currently sporting a very high dividend yield of somewhere between 10 and 15%. I'd have to check the exact number today, but I believe it's closer to 15% dividend yield on an annual basis right now. So a very high dividend yield, also could be a little bit undervalued, could be an interesting play. We also have refiners, which are incredibly beat up, and there's been insider buying in some of these refiners. So PBF Energy is one of those. It's trading at a level that's very, very discounted to where it was trading just a year ago. So even where it started the year, if you look year to date, this was a $25, $30 stock. Today, sporting a $5, $6 stock price, and there's been a bunch of insider buying, including from Carlos Slim, who has been buying about a 20% stake in this company. Of course, that's one of the richest men in the world, Carlos Slim, a lot of assets that he controls in Mexico. But he has been buying some of this, which is weird because this is a small refiner in the U.S., and this is a very beat-up stock. And then there's also Marathon Petroleum, which is the largest refiner in the U.S. Very, very interesting, though. They have a couple of businesses that they own. They own one of the largest chains of gas stations, which they are selling to 7-Eleven. They have a deal to sell those to 7-Eleven for about $21 billion pre-tax. Post-tax, that should be about $16 or $16.5 billion of proceeds for MPC. And they get to retain their refining business and their stake. They have a majority stake in MLP called MPLX, which owns a bunch of pipeline and transport infrastructure. So if you value MPLX at current market prices, and you could even make the case that it's undervalued currently, but if you value MPC's stake in MPLX, and then you look at the cash that it's going to get from the 7-Eleven transaction, and what you're left with essentially is you're paying a very, very small price for the remaining refining business. And again, this is the largest refining business in the country in the U.S., so you're paying just a couple of $1 billion for that. And in a normal year, that business was producing a couple $1 billion annually of operating profit. So you're paying like 1 to 2 times annual operating profit, which is a very, very low multiple. So very, very bearish expectations built into the current stock price. And this was a stock that was starting the year at $50, $60 a share. So today trading at 30 and having more clarity on getting cash from the sale of its gas stations and having the potential to pay shareholders a nice special dividend and things like that is a pretty interesting situation in my book. So I'll keep an eye on this, especially if it continues to drift down. Could become an incredibly compelling risk-reward situation where you end up getting the refining business for free at a certain price. So that's another one I'm watching. And then, of course, other energy companies that I mentioned in the past, like Devon Energy, which is merging with WPF Energy? I believe that's the name. And Devon, by the way, is a very, very well-run company. Isn't all that leveraged. It doesn't have a ton of debt like a lot of other energy companies do. They're actually producing free cash flow still, even with lower oil prices this year. Just a very, very well-run company. And despite that, its stock has been more than cut in half this year. So in a recovery scenario for energy, this one could be an interesting one to watch as well. So those are just some companies I'm thinking about, in the energy sector, refining sector, that could be interesting if the Democrats don't sweep the elections. It might get a nice bump. Other areas that might be worth looking at, defense companies, for-profit education companies, those would be some areas that might benefit as well from Republicans at least retaining some of either the presidency or the Senate or both. So just thinking about, what isn't being priced into markets right now. Not saying that's going to happen, but definitely worth thinking about what the upside could be on some of these things if it were to happen. So that's kind of the stuff I'm watching this week. We'll continue to look at earnings reports and things like that to monitor what situations might pop up. Of course, we do see from time to time really big sell-offs on earnings. I've talked about in the past where I was able to pick up stakes in companies, really good companies like Twitter or Stitch Fix at really rock bottom prices. I was able to pick up Twitter on some of these massive drops that it had on some of their earnings results. And that was a really good time to pick up stocks like this. Stitch Fix was another one in the spring time frame. I was able to pick this one up after hours when it was down like 40% at one point after hours, even though the earnings results looked pretty good to me. So I believe that was a $12, $13 stock price pickup. Today, it's trading for almost 3 times that level. So that was a really nice way to get into a stock that I'd been watching on a really, really big correction when investors got overly worried about what they were seeing with the earnings reports. So again, earnings, great time for entries and exits on certain things. You just got to be paying attention, doing the work, being prepared, and that's what I plan to do in this earnings season like any other. So hopefully that gives you some ideas and some things to think about this week. And as always, hit me in the comments if you have any questions or stock ideas or things you want me to take a look at. Take care, everyone.